When it comes to investing, the majority of my investments are in dividend-paying stocks, ETFs, or index funds. I like the idea of passive income, and I have a goal of generating more than $100,000 in annual dividend income. But that doesn't mean I invest only in dividend-paying investments. Nope, not at all. I actually carve out a position within my strategy to invest strictly in growth stocks or non-dividend paying companies. As such, in today's video, it's going to be a little bit more unique than what you're accustomed to where we talk about dividend stocks. In today's video, we are going to focus on two non-paying dividend stocks that I believe in the future will in fact be paying dividends. So if you're excited for today's video, do me a huge favor. Click that like button down below, subscribe to the channel so you're notified anytime we drop new content, and let's jump into it. Hey everyone, Mark Rushin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. So why in the world do companies pay dividends in the first place? Well, when you own shares of a particular company, one way for them to share profits with their shareholders is by paying a dividend, or they can do share buybacks. And a lot of misconceptions out there with dividends is the fact that if companies are paying dividends, they're likely not reinvesting back into the business. Well, I'm here to tell you that companies can do both. However, not all companies out there, as you know, pay dividends. And that's the fact that they need every single penny right now to be reinvested back into the business for growth initiatives. And both of these companies that we're looking at today are doing exactly that. But before we jump into today's video, let me tell you quickly about today's video sponsor, which is SNHU, or Southern New Hampshire University. Have you ever, or are you currently in a role that you cannot progress through the ladder due to the fact that you don't have the proper education? Don't let education be the reason that you're and climb your profession. After all, typically, the higher we're able to climb, the more money we can potentially make. That's where SNHU comes in. SNHU has one of the largest accredited nonprofit online degree offerings in the country today. And the best part is, you don't have to empty the wallet entirely. In fact, they have incredibly affordable tuition rates. Their online tuition rates are some of the lowest in the nation. Here's an example for a finance degree, where you can see not only a description of the program, but also up-to-date average salaries for those that have obtained this degree. Just go to snhu.edu/Mark, also linked down in my description below, to find a program that suits you, and you can request free information and talk to a representative. So now let's get back to our video discussing two potential future dividend payers, beginning with our first future dividend stock, which is the Walt Disney Company, stock ticker DIS. This might be cheating or cherry picking due to the fact that the Walt Disney Company in the past has actually paid a dividend. The company began paying a dividend back in the early 90s, but it was not consistent. And since then, it took a few breaks around the year 2000. But since 2000 through the year 2019, they had been paying a rather consistent dividend. The pandemic, however, brought all that to a halt, but the timing made sense. After all, Disney had been in talks for a while about starting their own streaming service to rival the likes of Netflix. And lo and behold, we now have Disney Plus, which was launched at the end of 2019. Just a few months later after the launch, the entire world was hit with a global pandemic. And where did many consumers or people find themselves? Stuck in their homes watching television. Disney Plus got a huge start due to this and saw their subscribers quickly grow year in and year out through Q4 2022 and topping out at over 164 million subscribers. However, the pandemic in the rearview mirror now, the growth has slowed and subscribers have dropped for 3 consecutive quarters now, down to 146.7 million subscribers. By the end of 2022, when you include all of Disney's subscribers, not just Disney Plus, they had surpassed that of Netflix. And those subscribers include Disney Plus, Hulu, and ESPN Plus subs as well. All of this to say, Disney has been very focused on continuing the rollout, the successful rollout, and pouring more money into Disney Plus, and also trying to turn a profit, something they expect to do by the year 2024. So it definitely makes sense that in terms of when the company generates free cash flow, they are reinvesting back into not only Disney Plus, their parks, but also paying down debt. However, that does not mean I expect a dividend anytime soon. I want to see them continue to pour into Disney Plus, get the parks back on track, which will also increase free cash flow. Then we might start seeing a dividend from the Walt Disney Company. Let's now take a look at the cash flow statement right now to see what type of free cash flow numbers Disney is generating. Through the first 9 months of their fiscal year, Disney has generated $1.5 billion in free cash flow, a substantial increase from the same period a year ago due to higher operating income from parks. You can see here now, this chart, how the company continues to aggressively reinvest back into the business, spending $3.6 billion so far this year in CapEx and $3.8 billion over the same 9-month period a year ago. We fully expect the Disney Plus subscribers to level out, but again, once parks and resorts can get humming again, that's definitely going to increase the company's free cash flow, which will again allow them to not only reinvest back into the business, but potentially pay a dividend. Meanwhile, the stock has been punished, falling from a high of $118 at the start of February 2023 to now trading closer to $80 flat. That's roughly a 30% drop from its 52-week high. This is a stock that nearly reached $200 back in 2021. Analysts are largely bullish on the stock as well at these lower levels, with the street having an average 12-month price target of $108 per share, implying more than 31% upside from the current levels. The street high has a price target of $145, which was an extremely bullish position. If things continue to progress and free cash flow levels continue to climb higher, definitely look for Disney to be paying a dividend in the near term over the next, say, 2 to 3 years. Now moving to future potential dividend stock number 2, which is Amazon, stock ticker AMZN. Now for Amazon, unlike Disney, they have never paid a dividend. So this would be entirely new territory for the retail giant. And that's exactly what many of you know Amazon as, a retail company, but they are so much more. Looking at this chart as of Q2 2023, you can see they earn revenue from a multitude of different businesses. They have online sales, third-party fees, AWS, which is far and away their most profitable segment of the business, advertising, which continues to grow, subscriptions, think of Amazon Prime, Amazon Music, Prime Video, just to name a few, and physical stores, think of Whole Foods and Amazon Fresh. The business is flush with different angles to make revenues. And they are also venturing into other industries like healthcare. So it makes sense for the likes of Amazon to continue to plow its cash that it generates year in and year out back into the business because it's working. If you look at over the past 10 years, over the past decade, Amazon has average returns of 20%. The retail side of the business, which is what everyone knows Amazon for, is a very low margin business. AWS is where their highest margins come from, and that's where investors focus a lot of their attention in. But I can definitely foresee a future where things start to slow down and not growing at the speed that it is today, to where we see Amazon generating huge amounts of free cash flow, where they're not needing to reinvest as much back into the business, and they're just going to start stockpiling cash, a very similar route to what Apple did, and then it eventually paid a dividend. Over the trailing 12 months, Amazon has generated an impressive $7.9 billion in free cash flow, which was actually an outflow during the same period last year. After paying down debt and lease obligations, the company still has nearly $2 billion in free cash flow remaining to reinvest back into the business, even more, pay a dividend, or repurchase shares if they so choose. Over the past 12 months, shares of Amazon have climbed 10% to a market cap of $1.4 trillion, slightly underperforming the S&P 500 over that same period. Analysts are also high on the stock, rating it a buy with an average 12-month price target of nearly $170, which implies 23% upside from current levels. Both of these companies are still in growth mode with growth initiatives. Disney trying to grow their Disney Plus platform, also trying to get their parks back in order. And then there's Amazon with a ton of different areas that they're involved in right now and continuing to grow. So great reason to not pay a dividend right now. However, even though I think both of these companies will pay a dividend in the future, if I had to choose which one will be paying a dividend sooner rather than later, it's definitely going to be the Walt Disney Company. Number one, they've already done it in the past. They've made comments about reinstating their dividend, so I definitely can foresee Disney starting to once again pay a dividend within the next 2 to 3 years. Down in the comments section below, let me know which of these two stocks are you more high on, not just for paying a dividend in the future, but which would you rather buy at current levels? Is it Disney or is it Amazon? Thanks again for watching. If you haven't done so yet, make sure you smash that like button down below, subscribe to the channel, join us for one of our live sessions every Thursday out there for the Dividend Power Hour. Thanks again for watching, and we'll see you in the next video. Take care.